Good day, everyone. My name is Adrian Chui. I am the Chief Executive Officer and Executive Director of ESR Funds Management Singapore Limited, the manager of ESR REIT. Today, I will be sharing with you an overview of ESR REIT, key takeaways of our business operations, investment highlights, as well as a brief transaction overview of the proposed merger with Sabana REIT. ESR REIT is a Singapore-focused industrial REIT. As at 30th of June 2020, our portfolio consists of 57 properties with an average occupancy of 91.1%. Our total portfolio gross floor area is 15.1 million square feet with a weighted average lease expiry of 3.4 years. Our portfolio consists of business parks, high-specs industrial, logistics, warehouse, and general industrial assets, all located in Singapore, and we have over 340 tenants over various trade sectors. Our portfolio of 57 assets totals 3.1 billion, located close to major transportation hubs and within key industrial zones across Singapore. Moving to slide 7. This gives you a snapshot of our latest financials. Operational excellence and portfolio resilience have been a key focus area in our strategy as we sought to overcome this challenging period amidst the global pandemic. In the first half of 2020, we continue to enhance the performance of ESR REIT through proactive asset management, prudently managing our capital structure while seeking ways to increase revenue and DPU by optimizing our portfolio through divestments, acquisitions, and asset management. While gross revenue before COVID-19 rental rebates for the first half of 2020 was 118.4 million compared to 128.6 million in the prior period, and net property income for the first half registering at 80.2 million, which is 16.8% lower than the previous year. The lower gross revenue, NPI and DPU was mostly due to the following factors. The first are lease conversions from single to multi-tenancy for 7 properties across 2019 and the first half of 2020, from single to multi-tenancy basis, where ESR REIT has to bear the cost of land rent, property tax, maintenance fees that tenants used to bear under the master lease arrangement. Second, non-renewals and downsizing of certain tenants has contributed to this drop in revenue. Rental rebates set aside for and or given to tenants as part of ESR REIT's measures to support tenants adversely affected by the COVID-19 outbreak. About $7 million of distributable income from the first quarter of 2020 retained for cash flow management purposes, and finally, no distribution for other gains in the first half of 2020 as we hold back some of the larger AEI projects in view of COVID-19. Slide 8 gives a graphical snapshot of the factors that I mentioned. Our distributions for the first half of 2020 is at 1.162 cents. This lower DPU in 1H 2020 compared to the previous year was mainly due to the following. First, provision of rental rebates to our tenants to mitigate the impact of COVID-19 outbreak and the subsequent circuit breaker measures. Second, halting of capital distributions. And third, the retention of $7 million distributable income in the first quarter of 2020 from prudent cash flow management. Based on the annualized first half 2020 DPU, ESR trades at 6.0% DPU yield, which is about 500 basis points above the 10-year Singapore government bond rate. As you can see in slide 10, ESR REIT has a well-diversified portfolio across the 4 asset classes. Almost 1/4 of our portfolio is in the logistics segment, and another 44.6% of the portfolio comprising future-ready business parks and high-specs industrial properties. About 67% of our logistics assets comprises modern, in-demand ramp-up logistics properties. We are constantly optimizing our portfolio, building a strong, balanced portfolio that is aligned with market trends while creating sustainable value for our unit holders. Given the trajectory of Singapore's economy towards digitalization and the growing momentum in e-commerce, we are enhancing our portfolio through divestments of non-core, low-yield, smaller properties and recycle the capital towards scalable properties with long-term growth prospects such as high-specs properties and ramp-up logistics facilities. Over the last 3 years, we have actively repositioned the portfolio away from single-tenanted buildings to multi-tenanted buildings, or NTBs in short. And this strategy of diversification has provided a resilient buffer for us during this COVID-19 pandemic. About 74% of our portfolio comprises multi-tenanted buildings, which diversifies tenant concentration and rental collections risk. Our portfolio occupancy improved to 91.1% in the second quarter of 2020 versus the last quarter of 90.5%. And our occupancy has always been consistently above JTC's average of 89.2%. Despite the challenging operating environment, leasing activities gained traction in the first half of 2020. We signed a total of 49 new leases, which amounts to 1.18 million square feet, and renewed approximately 765,000 square feet of space in the first half of 2020, bringing the total leases signed in the first half to 1.95 million square feet. ESR has a diversified tenant base of 343 tenants with weighted average lease expiry of 3.4 years as at 30th of June 2020. The portfolio's weighted average security deposit is 5.5 months for the multi-tenanted buildings, and for the multi-tenant buildings at 4.1 months and the single-tenanted buildings at 9.5 months. Next, on slide 11. Our top 10 tenants account for 30.7% and 27.9% of ESR REIT's portfolio by rental income and net leasable area respectively, with no single tenant accounting for more than 5.2%. Majority of our top 10 tenants are in the logistics and or advanced manufacturing businesses. These are resilient and essential sectors, especially in view of COVID-19 situation. We have a diversified tenant base comprising over 340 tenants across major industrial trade sectors, with no individual trade sector accounting for more than 29.9% of our rental income. Looking ahead, challenges in the operating environment are likely to persist, even with the growing demand in high-specs industrial and logistics sector. Although industrialists are scaling up their local and regional presence given the disruptions in global manufacturing supply chain, price and rentals of industrial space are likely to remain muted due to the impact of COVID-19 and the global uncertainties stemming from the ongoing US-China trade tensions expected in the coming months. Now, moving on to capital management on slide 12. Our capital structure is well balanced. As of 30th June 2020, our gearing stands at 41.8%, with all of our debt on an unsecured basis. We have hedged 88.3% of our total debt into fixed rates of 2.7 years, and our weighted debt expiry is also standing at 2.7 years. Our current interest cover ratio is 3.4 times, above the statutory requirement of 2.5 times, which will be enforced on the 1st of January 2022 onwards. We continue to enjoy strong banking support due to the strength and the size of our diversified portfolio and the credit standing of ESR REIT being part of the ESR Cayman Group. We do not foresee any refinancing risk in the coming months, as we have $110 million of available committed credit facilities on hand. As you can see on slide 13, while there has been feedback that our gearing at 41.8% is relatively high compared to our peers, we would like to point out that our debt expiry profile is well spread out, with no more than 33% of our loans expiring in any particular year and are all on an unsecured basis. We continue to have access to alternative pools of capital and enjoy strong banking support from a range of local, regional, and international banks at competitive terms. A case in point, earlier this year, we refinanced our $160 million of expiring bond with an unsecured bank loan with a longer tenor and at lower cost. This loan was obtained way in advance of our expiry, validating the strong banking support that ESR REIT had received, especially since the merger of ESR REIT with Viva Industrial Trust in the late 2018. Our cash position is stable, and we do not have any refinancing needs for the rest of 2020. Our next refinancing requirement is in the second half of 2021, and we will continue to be prudent in our cash flow management. For example, by focusing on operational cost measures and reviewing major AEIs in line with the economic situation where possible. Turning to slide 14. An important metric for the sustainable growth and support of a REIT is the quality of the sponsor. Our sponsor, ESR Cayman, is the largest Asia-Pacific focused logistic real estate platform by gross floor area and by value, and has the largest development pipeline in aggregate across major Asia-Pacific markets. ESR Cayman's assets under management stands at US $22 billion, and a portfolio measuring 18.7 million square meters. Having a strong developer sponsor provides us access to a steady pipeline of assets to expand overseas in the future without changing the underlying risk profile of our REIT greatly. Our sponsor's assets are majority freehold and or on long-term land lease tenures, which is able to mitigate the short land lease tenures of Singapore industrial properties. We will now move on to the transaction overview of the proposed merger with Sabana REIT. On 16 July 2020, ESR REIT announced the proposed merger with Sabana REIT. The proposed merger is expected to bring greater scale and deeper presence to unit holders of both REITs respectively. The benefits that unit holders of both REITs are expected to enjoy are: number one, the transaction is DPU and NAV accretive for ESR REIT, and with one of the highest DPU accretion of 12.9% for Sabana REIT unit holders on a historical pro forma basis. The merger is going to enhance the diversification and resilience of the enlarged REIT platform. ESR REIT will continue to be a 100% pure play Singapore REIT with operational synergies, organic portfolio growth and optimization potential. This enlarged asset base and enhanced balance sheet flexibility better positions the enlarged REIT to pursue further growth opportunities. Improved growth outlook from potential operational synergies as well as lease-up and asset enhancement initiative opportunities. And lastly, in REITs, size does matter. The enlarged portfolio solidifies the REIT's position as a benchmark developer-backed industrial S-REIT with a larger free float and higher expected trading liquidity with potential inclusion in key indices, which in turn leads to competitive cost of capital. These enlarged REIT will continue to have the support of a strong developer sponsor, the ESR Cayman Group, with financial support, access to its visible pipeline of quality assets, and on-the-ground network across Asia for sustainable growth. The scheme consideration payable to Sabana REIT unit holders is based on a fixed gross ratio of 0.94 times. It is not a fixed price offer. As such, the implied offer price is directly correlated to the ESR REIT's unit performance and will rise or decline according to market movements. The terms of the merger have been heavily negotiated and agreed between the ESR REIT and Sabana REIT managers. We believe that the terms of the merger are fair and will result in a win-win outcome for ESR REIT and Sabana REIT unit holders. Our terms are final, and only if a competitive bid situation emerges, we will have a right to review our offer. If the proposed merger is approved by the respective unit holders, ESR REIT will be the surviving entity with 75 industrial properties, all located in Singapore, valued at approximately 4 million. The enlarged REIT will continue to be managed by ESR REIT Funds Management, Singapore Limited. And with that, I end my presentation. Thank you everyone for your time and have a good day ahead.